Imagine you wake up one morning, open your banking app, and the numbers are all still there. Your balance says 10,000. Your retirement account still shows the same 6 figures it did last month. On paper, nothing has changed. But when you walk outside, the bakery on the corner is charging 5 times yesterday's price for the same loaf of bread. Your rent is suddenly being revised. Your salary buys half the groceries it used to, and when you go back to the bank to complain, they shrug and say, that is just the new reality. Your money still exists. Its power has quietly vanished. The reason I am starting here is that this scene has played out again and again across history in different languages with different flags, under kings, emperors, democracies, and dictators. The details change. The pattern is unnervingly familiar, and every single time it happens, one question decides who gets ruined and who walks through the storm with their wealth not just intact, but sometimes multiplied. The question is not how many zeros are in your bank account. The real question is, what is your wealth actually made of? Is it made of promises, or is it made of something the promises are written on? Gold has been one of the most enduring ways humans have tried to answer that question. So in this video, I want to treat gold like a time axis that runs underneath 5,000 years of money. We will move from ancient coins to the classical gold standard to Bretton Woods and into our modern fiat era. Along the way, we will drop into a few moments when paper currencies collapsed or inflation ran out of control, and we will look very concretely at who lost their purchasing power, who protected or even expanded their wealth using gold or other real assets, and where the story of gold is a lot less magical than its fans like to claim. Because history is pretty clear on 2 things. First, paper and digital money are fragile. They can be redefined, redenominated, or abandoned altogether. Second, owning gold has sometimes saved families and sometimes done almost nothing for decades. There are real limits on its returns, its liquidity, and the political risks that come with it. So by the end of this, I want you to feel like you understand the pattern more than the slogan. Not gold is always good or gold is obsolete, but how gold actually behaves when currencies change the rules. Let us start at the beginning. If you zoom way out, long before there were dollars or euros or yen, humans already understood 2 big ideas. 1, that you can trade your time and effort today for something that holds value into the future. 2, that whoever controls the unit of that value quietly controls a lot more than it looks like. In the river valleys of ancient Mesopotamia and Egypt, wealth was recorded in grain, livestock, and later in metals like silver and gold. Those metals did not start out as money the way we think of it today, but they were special. They were beautiful, did not rust, were easy to divide, and rare enough that you could pack a lot of value into something you could hold in your hand. Over thousands of years, temples, palaces, and merchants learned that you could measure debts and dowries in weights of metal, counted out on scales. But something important was missing. Every transaction still required weighing and testing the metal. There was no quick way to hand someone a piece of gold and have them instantly know what it was worth. Around the 7th century, before the Common Era, in a small kingdom called Lydia in what is now Western Turkey, somebody solved that problem. Lydian rulers began stamping pieces of a natural gold-silver alloy called electrum with a royal symbol and issuing them in standard weights. Soon after, King Croesus started minting separate, standardized gold and silver coins. For the first time, metal did not just have value because of what it was. It had value because of what it represented, the authority and promise of a state. A small stamped disc could move through markets, across borders, and between strangers with almost no friction. That was the birth of coinage, and it set up the story we are living in today. From that point forward, gold lives a double life. On one level, it is just a shiny metal used for jewelry and decoration. On another level, it is the reference point that entire monetary systems are built around or rebel against, and when those systems crack, gold often steps out of the background and becomes the emergency exit. To see how that works, let us jump to one of the first great paper money and inflation disasters. The Roman Empire did not use paper money, but it absolutely did use what we would now call stealth devaluation. For centuries, the backbone of Roman cash was the silver denarius. Over time, as the empire's military and administrative costs exploded, emperors began to quietly reduce the silver content of the coins they issued. By the 3rd century, during a period historians call the crisis of the 3rd century, the main silver coin used to pay soldiers, the Antoninianus, had lost about 95% of its silver content compared with when it was introduced. More coins, less silver per coin. That meant the army could be paid with what looked like the same money, but each coin contained far less real metal. Prices reacted the way you would expect. Records suggest that the price of basic goods like wheat multiplied dozens of times over the course of that century. One estimate compares a bushel of wheat that might cost a single denarius early in the empire to hundreds or tens of thousands of denarii by the early 4th century. Who lost in that early inflation? Anyone whose livelihood depended on fixed payments in coin, soldiers, lower-level officials, urban workers who were paid wages. Their money kept arriving. It just bought less and less. Ordinary city dwellers with savings in coin saw those savings hollowed out. Retirees who had loyally accepted their pensions in imperial currency discovered that the coins were a bad joke. Who held up better? Peasants and large landowners who could feed themselves and pay each other in kind, in wheat and wine and oil instead of coins, were relatively sheltered. So were the very wealthy who owned land, slaves, and access to tax revenues, and who could demand payments in more stable forms like gold or goods. Gold itself played a quiet but important role in this period. While silver coinage was debased again and again, gold coins like the aureus and later the solidus kept a much higher purity. Their gold content changed far less than the silver content of everyday coins. As the imperial silver money became almost worthless, trade among elites and across borders retreated into gold coins and into barter in real goods. In other words, people who had wealth in land and gold could still operate. People whose wealth was denominated purely in the state's everyday money got crushed. It is an early version of a pattern we will see again. When the unit of account fails, the people closest to real assets are last in line to feel it. Now fast forward more than 1,000 years to another famous monetary mess, revolutionary France. In the late 1780s, the French monarchy was broke. The government had huge debts and not enough reliable tax revenue. When the revolution erupted, the new authorities seized church lands and created paper notes called assignats, originally as interest-bearing bonds backed by those properties. Very quickly, those bonds morphed into a general paper currency. At first, it seemed like a masterstroke. The new government had a way to pay soldiers and officials and suppliers. Trade picked up, a shortage of coins eased. But there was a political temptation baked into the system. Because the notes were backed by land, legislators felt free to print more and more. Over a few years, the total face value of assignats in circulation ballooned far beyond the realistic sale value of the confiscated properties. Counterfeiters, including some operating abroad, added to the flood. Prices took off. The paper franc began to collapse. There were food riots, black markets, and eventually a complete loss of confidence. By the mid-1790s, the assignats were essentially worthless and were replaced by a new paper currency, the mandats territoriaux, which also failed within months. In the end, France went back to metal coins. So in this episode, who lost? Urban workers whose wages were paid in paper, small savers who trusted the revolutionary government and held assignats, people on fixed incomes who could not raise their prices. Their purchasing power evaporated even as the number of notes in their pockets rose. Who came through in better shape? Owners of productive land who could demand rent in grain or in stable coin rather than in paper. Merchants and farmers who were able to pivot to barter or foreign currency. People who managed to convert assignats into real estate early, before the full flood of later issues often emerged with genuine property paid for in notes that later went to zero. Gold in this era acted less as an official anchor and more as an underground yardstick. As the paper currency deteriorated, both domestic and foreign traders increasingly calculated values in terms of how much precious metal or how many foreign gold coins a transaction was worth. People who could hold or access metallic money and foreign exchange protected their position far better than those trapped in paper. Already we are seeing an important nuance. In a crisis, it is not just gold holders win, paper holders lose. It is that people with any kind of real, scarce, in-demand asset land, gold, foreign coins, even durable goods, have more options than people whose entire world is denominated in whatever the government is printing. Now let us step into the 20th century, because this is where the story starts to look uncomfortably familiar for anyone living in today's fiat currency world. For roughly a century before the First World War, most of the major trading nations operated on some version of what economists call the classical gold standard. Britain formally adopted gold in the early 1800s, and by the late 1800s, many countries had either pegged their currencies to gold or tied them indirectly through the British pound, which was itself redeemable in gold at a fixed rate. Under that system, each currency was defined as a certain weight of gold. Central banks held gold reserves and stood ready, at least in principle, to exchange notes for bullion. Gold moved between countries to settle trade imbalances, and because total gold supplies grew slowly, long-term inflation in many gold standard economies was very low. Over the full period from about 1870 to 1914, average inflation in major economies was close to zero, though that disguised big swings between periods of inflation and periods of deflation. From a saver's point of view, that stability in the price level was appealing. If you held a government bond or cash under your mattress, your purchasing power would often be roughly similar decades later. But from the point of view of workers and debtors, the story was more complicated. Periods of deflation meant that debts taken out in easy years became harder to repay. Fixed gold convertibility restricted how far governments and central banks could cut interest rates or create money during downturns. Many economic historians argue that the rigid gold standard helped turn normal recessions into severe depressions in the late 19th century because policymakers were unwilling to risk losing gold reserves. In other words, tying money directly to gold protected savers against inflation, but also made the system brittle. When big shocks hit, something had to give. The First World War was exactly that kind of shock. Governments suspended gold convertibility so they could finance massive military spending with debt and money creation. After the war, some countries tried to go back to gold at pre-war exchange rates, but their economies had changed, and their old parities were often unrealistic. Britain famously returned to gold in the 1920s at an overvalued rate, which many economists believe contributed to unemployment and deflation. Then came the Great Depression. Between the stock market crash of 1929 and the early 1930s, global output shrank, banks failed, and unemployment soared. Countries still tied to gold were severely constrained in their responses. To defend their gold reserves and their exchange rates, they raised interest rates and cut spending even as their economies were collapsing. History shows that the countries that abandoned the gold standard earlier, like Britain in 1931, generally began to recover sooner than those that clung to it, like France and, for a time, the United States. This is important for our theme, because it is one of the first big modern examples where the people who believed in gold, in a very literal, legal sense, the governments that promised to redeem their currencies for gold at a fixed price, found that those promises conflicted with political survival. In the United States, the breaking point came in 1933. As banks failed and people hoarded coins, President Franklin Roosevelt took a series of extraordinary steps. He temporarily closed banks, took the United States off the domestic gold standard, and signed Executive Order 6102, which required most private citizens to turn in their gold coins, bars, and certificates to the Federal Reserve in exchange for paper dollars at a fixed rate of $20.67 per troy ounce, with some exceptions for small amounts, industrial users, and collectors. The following year, the Gold Reserve Act revalued gold to $35 per ounce, effectively devaluing the dollar and creating a windfall for the government, which now booked a much higher dollar value for the same physical gold. So in that episode, who lost and who came out ahead? Ordinary Americans who had carefully saved in gold coins and obeyed the order to hand them over certainly did not gain from the revaluation. If you gave the government an ounce of gold in 1933, you received about $20. A year later, that same ounce on the government's books was worth $35, but you were still holding the 20. The benefit of the devaluation accrued to the state, which could expand the money supply and run deficits with a bigger buffer of gold valued in dollars behind it. People who ignored the order and hid gold illegally sometimes did very well financially, but they carried legal risk for decades. Private ownership of bullion remained tightly restricted in the United States until the 1970s. On the other hand, debtors, including mortgage borrowers and some businesses, benefited from the dollar devaluation because their nominal debts did not rise along with prices. As the recovery took hold later in the decade, they could pay back loans with cheaper dollars. Savers who had sat in cash lost purchasing power as prices and wages gradually rose from their early Depression lows. The gold lesson from the 1930s is a sobering one. Gold can protect you against the failure of a currency, but only if you are actually allowed to hold it and use it freely. When a government is under extreme pressure, it can and sometimes does change the rules around gold ownership to reassert control over the monetary system. Now jump ahead to the other side of the Second World War. By 1944, leaders of the Allied nations knew that the chaotic interwar monetary system had helped turn a financial crisis into a global depression and war. They wanted a framework that restored stability to exchange rates but gave governments more flexibility than the old, rigid gold standard. At a conference in Bretton Woods, New Hampshire, 44 countries hammered out a new order. Under the Bretton Woods system, the United States dollar was pegged to gold at $35 per ounce, and other major currencies were pegged to the dollar. Central banks could hold dollars as reserves, and the United States promised to redeem those dollars held by foreign governments for gold on demand. Institutions like the International Monetary Fund were created to help countries manage short-term balance of payments problems without immediately devaluing. For about a generation, this arrangement delivered what people had craved in the 1930s: relatively stable exchange rates, high growth in the developed world, and moderate inflation in many countries in the 50s and early 60s. The United States accumulated the bulk of the world's official gold reserves, and the dollar took on the role of global reserve currency. But again, the seeds of the next regime change were already sprouting. As European and Japanese economies recovered and trade expanded, more and more dollars accumulated overseas. At the same time, the United States was running large deficits to finance both Cold War military commitments and domestic programs. Foreign governments, especially France under President de Gaulle, began to question whether the United States had enough gold to honor the promise of conversion at $35 per ounce. Some started to redeem dollars for gold in significant quantities. By the late 1960s and early 1970s, the math no longer worked. There were far more dollars held abroad than the United States had gold at the official price. On August 15, 1971, President Richard Nixon announced that the United States would temporarily suspend convertibility of the dollar into gold. In practice, that temporary suspension became permanent. Over the next few years, major currencies shifted to floating exchange rates, and the last formal link between everyday money and gold was gone. Once again, we can ask, in that reset, who lost and who gained? Foreign governments and central banks holding large stacks of dollars lost the option to turn those claims into gold at a fixed price. They were left holding paper and electronic claims on the United States, backed by its taxing power and economic strength, but no longer legally anchored to a metal. Ordinary citizens in the United States and other countries did not see an overnight catastrophe. Their bank balances and wages were not deleted. But over the following decade, they did experience something they had not seen in a very long time: sustained high inflation. From the early 1970s through the early 1980s, consumer price inflation in the United States, the United Kingdom, and many other developed economies ran in the high single digits to low double digits for years at a time. Oil shocks, wage price spirals, and changing expectations all played a role. A dollar or pound saved at the start of the decade lost a large chunk of its real purchasing power by the end. During that same period, gold, freed from its fixed $35 price, went on a legendary run. From the early 1970s, when Americans were once again allowed to own bullion, to its peak in early 1980, the market price of gold in dollars rose by more than an order of magnitude. People who had held significant portions of their wealth in gold or shifted into it early in that decade saw their purchasing power not only preserved but multiplied. Someone who sold a family house for gold at the official price in 1971 and then sold that gold for currency in 1980 could, in some markets, have bought several equivalent houses. But there is a flip side that gold enthusiasts sometimes gloss over. From that peak in 1980, gold entered a long, grinding bear market. In nominal terms, the price fell and then went sideways for roughly 20 years. In inflation-adjusted terms, someone who bought at the peak waited decades to break even. Studies of long-term asset returns in the United States suggest that over very long horizons, stretching back more than a century, gold's average real return has been close to zero or even slightly negative, while stocks have delivered several percentage points of real return annually and bonds a bit more than 1% per year. So, in that sense, the 1970s are a double lesson. In a decade of monetary stress and inflation, gold did exactly what its reputation suggests. It shielded wealth from the erosion of paper. But in the decades of relative stability and financial innovation that followed the Volcker era, gold mostly marked time while other assets compounded. People who kept their entire nest egg in bullion from the early 1980s onward often fell far behind those who held diversified portfolios of productive assets like businesses and real estate. To understand why, it helps to look at some more extreme cases where paper currencies did not just inflate but imploded. The classic modern example is Weimar Germany in the early 1920s. After the First World War, the new German Republic faced heavy reparations, political turmoil, and a damaged industrial base. To meet its obligations and fund government spending, it relied heavily on printing money and on borrowing in its own currency. The mark began to slide. As expectations of further inflation took hold, the slide turned into a dive. By late 1923, one United States dollar bought trillions of paper marks. A loaf of bread that had cost hundreds of marks the year before cost hundreds of billions or more. Who lost? Middle-class Germans holding savings in bank deposits or government bonds saw those savings obliterated. Pensioners on fixed incomes were ruined. Salaried workers were paid ever more frequently, sometimes daily, because by the end of the week their wages might buy almost nothing. Who held up better? People who had debts denominated in marks sometimes managed to pay them off with what was effectively confetti. A mortgage taken out earlier in the decade could be extinguished with the price of a tram ticket by the end. More importantly for our story, people with access to foreign currency, gold, or tangible assets fared much better. Contemporary accounts describe families who had quietly stored gold coins or jewellery before the war being able to trade those for real estate and businesses at the height of the chaos, because desperate sellers were willing to swap property for anything that held value. Farmers with land and goods to barter were also in a stronger position than urban professionals with only paper claims. Gold, again, functioned not as an investment yielding a return, but as an anchor of purchasing power when the official unit dissolved. There is a similar story, with different local details, in mid-20th century China. In the 1930s and 1940s, the nationalist government moved off the traditional silver standard and issued a series of paper currencies while fighting both the Japanese invasion and the communist forces. To finance deficits and war costs, it printed increasing amounts of money. Inflation accelerated into hyperinflation. By the late 1940s, a new unit called the gold yuan was introduced, supposedly backed by gold, at a conversion rate of millions of old yuan for one new unit. Officials promised stability. In practice, reserves were insufficient, confidence was low, and the new currency collapsed even faster than the old. Ordinary urban Chinese saw wages and savings disintegrate. There are documented stories of people lining up at banks with bags of paper money to exchange for gold bars during brief windows when redemption was allowed, only to see the window slam shut, private gold holdings outlawed, and then the paper itself reduced to scrap. Once again, those who could move earlier into physical assets, land, finished goods, foreign coins, or gold and silver hidden from confiscation, had a chance to preserve part of their wealth. Those who trusted the official paper to hold its value paid for that trust with their life savings. In Zimbabwe, in the 2000s, the story was even more extreme numerically, even if the global stakes were smaller. After years of economic mismanagement, land seizures, and falling production, the government turned increasingly to the printing press. Annual inflation eventually reached astronomical levels, with unofficial estimates running into the tens of billions of percent. At one point, the central bank issued a $100 trillion note. A loaf of bread could cost hundreds of millions or more in local currency. People's savings and pensions were wiped out. What did Zimbabweans, who could manage it, actually do? Many turned to United States dollars and South African rand on the black market. Others used gold literally in dust or tiny nugget form for day-to-day transactions, especially in mining areas, because the official paper was changing value faster than prices could be printed. Eventually, in 2009, the government abandoned the local currency and allowed foreign currencies to circulate legally. More recently, Zimbabwe has tried to reintroduce local units, including a gold-backed currency called the ZiG in 2024. But trust is fragile, and people continue to prefer hard currency or real goods wherever they can. Again, we see the same basic pattern. When a currency goes into a death spiral, people scramble toward alternative stores of value, and gold is one of the few that is recognized across borders and cultures. But there is a danger if we stop the story there, at the most dramatic collapses, because for every Weimar or Zimbabwe, there are many more periods where currencies do not vanish, they just quietly erode. And in those slower environments, the role of gold is more nuanced. Take Argentina, which has struggled with high inflation multiple times since the 1980s. In 1989 and 1990, inflation surpassed 2,600% per year. A later crisis in the early 2000s saw the end of a one-to-one peg between the peso and the dollar, a deep recession and a devaluation that saw the peso lose around 70% of its value against the dollar in a short period. Argentines who held all their savings in local currency bank accounts suffered heavy losses in purchasing power, but many middle-class families responded by informally dollarizing their lives. They saved in physical United States $100 bills, kept at home or in safe deposit boxes. They bought apartments in Buenos Aires, priced in dollars, used cars and appliances as stores of value, and, in some cases, gold coins and jewelry. These were not always spectacular investments. Apartments can fall in price and gold can go through long slumps. But relative to holding pesos, they often represented survival. We see something similar in Venezuela in the past decade. As the bolivar lost value at extreme rates and the country flirted with and then tumbled into hyperinflation, many Venezuelans began to use dollars informally for savings and large transactions. Some also turned to gold jewelry as a way to hold value that could cross borders. At the same time, the government clamped down on black market exchange rates and foreign currency transactions, which made it risky to rely on anything outside the official system. In these modern cases, gold is part of a broader basket of escape hatches that includes dollars, real estate, durable goods, and even in some cases, cryptocurrencies. It is valuable, not because it always goes up, but because in a crisis, it is one of the few assets that people on the other side of the border will still recognize. All of this history points to a couple of big themes about who loses in monetary breakdowns and who manages to preserve real wealth. The losers are almost always the same: people with savings stuck in the official unit of account, bank deposits, local currency bonds, cash in a drawer, people on fixed incomes that do not adjust with inflation, pensions, long-term wage contracts, government benefits defined in nominal terms, people without access to foreign assets, without the legal or practical ability to move money into other currencies or into gold or into property. By contrast, the survivors and sometimes the quiet winners tend to have at least one of three things. First, ownership of real assets that hold value across currency systems: land, productive businesses, commodity producing assets, and yes, at times, gold and silver. Second, access to alternative monies, foreign currencies, physical gold, or other precious metals, and in our era, diversified portfolios of global stocks and bonds. Third, enough flexibility to change how they earn and spend, the ability to raise prices, to move geographically, to change professions, or to shift wealth across borders. But this is where we have to be honest about the limits of gold as a strategy, especially if you are thinking about long horizons rather than a single crisis. Historically, gold has done a few things quite well. It has a remarkable track record of preserving purchasing power over very long stretches. A classic, if rough, comparison is that in ancient Rome, a high-quality men's tunic might cost about an ounce of gold's worth of coin, and today a high-quality suit might cost something similar in gold terms. The exact numbers are fuzzy, but the broad idea that gold tracks the long-run price of a basket of basic luxuries is not crazy. It has often spiked in value relative to paper during times of acute financial stress, such as the 1970s stagflation, the global financial crisis of 2008, or recent periods of geopolitical tension and low real interest rates. Central banks themselves, after decades of reducing their gold holdings, have in the last few years been net buyers, adding hundreds of tons per year to their reserves as a hedge against currency and geopolitical risk. And unlike a bank deposit or a government bond, a bar of gold is no one else's liability. It cannot default in the way that a bond issuer can. At the same time, gold has some very real drawbacks. 1. It does not generate income. Stocks pay dividends, bonds pay interest, rental property pays rent. Gold just sits there. Your return comes entirely from changes in its price. Over stable periods when inflation is low and investors are comfortable holding financial assets, gold has often underperformed. Data from the mid-1970s through 2020, for example, show that gold's average annual return was comfortably positive in nominal terms, but still lagged far behind broad stock indices and even behind many bond portfolios. 2. It is volatile. The same quality that makes it surge in crises can make it fall sharply when conditions normalize. Someone who bought aggressively at the peak in 1980 or at other speculative highs had to endure many years of disappointment. 3. It can be expensive or inconvenient to store and insure in physical form, and if you hold it indirectly through exchange-traded funds or pooled products, you are back to relying on intermediaries and legal structures rather than on a metal in your hand. Fourth, and crucially from a historical perspective, gold is not immune to political risk. We already saw how the United States government in the 1930s restricted private ownership and changed the legal price. Other countries have done similar things in different eras. In modern times, capital controls, taxes on gold transactions, and reporting requirements can all shape how useful gold really is in a crunch. Finally, gold is only one piece of a larger picture. The same long-run studies that show gold preserving purchasing power also show that diversified portfolios of stocks and bonds held over decades have historically delivered much higher real returns. That does not mean the future will be identical to the past, but it does mean that if you put every spare dollar into bullion because you expect imminent collapse, you are making a very strong bet against a century of data. So how do you reconcile these two realities? On one side, the undeniable fact that every monetary regime so far has eventually changed or ended. On the other, the equally undeniable fact that holding only gold would have left you far poorer than holding a mix of productive assets during the long, relatively stable stretches between crises. One way to think about it is not as gold versus everything else, but as claims on human productivity versus instruments that protect you when those claims are questioned. Most of the time, if you live in a reasonably stable country with functioning institutions, the best way to grow wealth has been to own slices of businesses and claims on future cash flows. That is what stocks and bonds are. They are ways to tap into streams of earnings and interest that rise over time with economic growth. But hidden underneath that ordinary world is a different layer, the layer of trust in the unit of account itself. When that trust wobbles or breaks, the rules of the game change quickly. In those specific windows, having some share of your net worth in something that is not just another claim on the failing unit of account can make an enormous difference. That something might be gold, it might be property, it might be shares of businesses that earn in foreign currencies. It might be a basket of global assets held outside your home jurisdiction. History does not give us a simple formula for how much of that outside money you should hold. Economists and financial historians argue about it constantly. Surveys of academic economists in the United States show almost no support for going back to a strict gold standard, because most believe that the economic costs in terms of unemployment and lost flexibility would outweigh the benefits of rigid discipline. At the same time, central banks themselves, who understand the mechanics of fiat money deeply, continue to hold and even increase their gold reserves in recent years. They are not doing that because they expect an apocalypse tomorrow, but because they see gold as one of several tools that can help manage risk in a world of large debts, global tensions, and shifting power. The lesson for individuals is less about idolizing gold and more about understanding your vulnerability to different kinds of monetary risk. If all your assets, your job, your pension, and your savings are tied to a single currency and a single country's policies, then your personal balance sheet is very exposed to that one set of political and economic decisions. If instead your life gradually accumulates a mixture, some exposure to global businesses, some savings outside your home currency, maybe some modest allocation to gold or other real assets, and, importantly, skills and flexibility that let you adapt to changing conditions, then you are, in effect, recreating at the personal level what some of the most durable families and institutions have done for centuries. They did not guess the exact date of the next crisis. They did not always hold the perfect hedges, but they avoided the most dangerous position in every regime change, being locked entirely into the promises of a single monetary system. One last note before we wrap up. Whenever we talk about future scenarios, especially about debt and currencies today, it is tempting to slip into certainty. You hear strong voices saying that a collapse is inevitable, that fiat money always fails soon, that gold is the only answer. History is a lot messier than that. There have been long stretches, like the post-war Bretton Woods era or the period from the mid-1980s through the early 2000s when inflation was contained, currencies were mostly stable, and people who stayed invested in productive assets did very well. There have been shorter stretches when inflation flared and then was brought under control by painful but effective policies. At the same time, there is no law of nature that says our current dollar-centered system has to last forever. Debt levels are historically high in many countries. Demographics are shifting. Geopolitics are tense. Central banks are experimenting with new tools and facing new constraints. Historical patterns suggest that over the very long run, monetary systems evolve, sometimes gradually, sometimes abruptly. The point of looking at 5,000 years of gold is not to claim that this proves some specific future outcome. It is to recognize how quietly and how completely monetary resets can change who really owns wealth. Romans paid the price of coin debasement centuries before academic inflation models existed. Middle-class French savers watched their assignats turn into wallpaper, while those who had moved into land and metal earlier survived. Weimar professionals saw life savings evaporate while farmers and gold holders bargained from a position of strength. Chinese shopkeepers experienced 3 million old yuan becoming one new unit and then watched the gold-backed note disintegrate too. Zimbabwean pensioners learned that a 100 trillion note can still be worth less than a loaf of bread. In each case, The surface numbers tricked people. The balances in their local money still showed up. What those numbers could actually command in the real world was what changed. Gold is not a magic answer to that problem. It is one of several tools with clear strengths and real weaknesses that human beings have used to navigate it. In the end, the real hedge is understanding. Understanding that money is a system of promises, that those promises are made by specific institutions under specific pressures, and that the rules have been rewritten many times. Understanding that real wealth is the capacity to command goods and services in the future, and that this capacity depends on what you own, not just what claims you hold. And understanding that you do not have to choose between blind faith in fiat and blind faith in gold. You can study how different assets behave in different regimes, how they complement and contradict each other, and how to design a life that is not wiped out by a single change in the rules. If this deep dive into 5,000 years of gold and money helped you see those patterns a little more clearly and gave you a more realistic sense of both the power and the limits of gold in preserving wealth, then I would love for you to stick around. If you want more long-form, historically grounded explorations of how financial systems actually work, how past crises played out, and how ordinary people navigated them, take a moment now to like this video, subscribe to the channel, and turn on notifications so you do not miss the next story. Because as you have just seen, the details change. The pattern keeps coming back. The more you understand it, the better your chances of being on the right side of the next rewrite.